Doug started with tech issues, and I couldn't get this working. So, and then Doug just had a tree crash in his house from all the snow. So, welcome to this this lovely LinkedIn Live on Friday. For those of you joining us, are going to enjoy this. But yeah, Doug. So what's going on over your house?
So, for those of you that are in the northern parts, there's a pretty big winter storm that just came through and really, really wet. So I've been watching these trees just kind of bend over the last couple of days. Kind of like reminds me of growing up in Ohio. It's kind of like that lake effect kind of snow that you get. And so this morning I'm trying to get out from this white heck that I'm in, and the snow blower, not snowmobile, that'd be fun, decided to bust on me. So it's this 2-stage snow blower, and the first stage just keeps pulling in the snow, and the second stage stops. The propeller stops. So that's fun. So about 85%. So I got a hand shovel the rest of that, and now a branch of a major branch of a tree just collapsed on the roof of my house. So thank God I still got hail damage to that a claim open already from last summer or last spring, Kirk. So we'll just add that onto the laundry list of insurance claims. I think as long as there's no hole in the roof, I think we'll survive for a couple months.
Well, that's all that matters, right? You get through the winter.
That's right. We're trying to send some, and we're going to try to send some your way because I saw your pictures. Kirk's trying to put an ice rink. He's up in Boston, so of course they got to have an ice rink. That's like Minnesota. That's kind of the heart of ice skate, of hockey in the United States. And unfortunately, he's got a swimming pool right now. So I'll send it your way. We got some single digits coming up in Minnesota, and maybe Boston. You get some precipitation and some cold weather to suffer the likes of me. So.
Yeah, well, as Doug says, we're trying to be creative this winter, and my boys heckled me till I gave in, and we built a hockey rink in the backyard, which right now is a pool. It started as a pool, and then it froze, and it was one day away from being able to actually walk and skate on it, and then now it's raining and it's 48 degrees. So that that skating rink turned into a pool. I will not be swimming it, although I might be taking my Wim Hof ice bath pretty soon. It's pretty cold out there. Hopefully this week we'll get a rink and we can skate on it. But ever the optimist, I'm hoping we can get some days in the next few weeks in Christmas vacation where the kids can skate on it. We can have a lot of fun. So that's the plan.
You can have it. I miss those Texas, what they say, 3 months of winter in 3 weeks. I miss that. It's like 70, 70, 70, 70, boom. And actually, for those of you in the South, it's happening today or this week. It's going to go from like 70s to 30, and winter's going to come in. And you know what? Couple weeks, you'll have a nice Christmas, and then, all of a sudden it'll be 70 degrees again, and you're enjoying a balmy spring in February. Welcome to the South.
Yeah, well, I can't get through the southern weather. To me, that doesn't work because I spent a few Christmases in Miami. It's just not Christmas. Having some lighted up reindeer in a tree while it's like 80 degrees out just doesn't feel like Christmas to me. Sorry, maybe I'm just a glutton for punishment, but that's what you get when you grow up in Boston. You miss the pain. you miss the challenge of the winter, but hey, it makes us all more resilient, or so I hear. So anyway, let's get started here. So hello, Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and I'm once again joined with my good friend Doug Hagren. How's it going, Doug?
You already know, Kirk. Awesome.
I know.
Yeah, but digging out of a blizzard, enjoying the fruits of December.
Well, good. So this week we got a lot of news this week. So let's just kind of dive right in and talk about some of it, and then we'll dig into the other stuff, which has been backed up for a few weeks, and I think it's also important to share. But let's start with this week. We had two big pieces of news. First, we had the Fed funds rate, or actually, first we had the CPI. Which came out this week, and the most recent CPI is 6.1. I think, is that what it is, Doug? Am I getting that wrong?
Yeah, something like that. Yes,
6.1. So the most recent measure is 6.1. It was at 6.7, I think it was, and it dropped a lot. So it actually dropped more than expected, which had the market celebrating that day, and everyone was excited because they figured, oh, we're going to go back to the way things were. And as you listeners of the show know, that's not happening. But people are optimistic, right? It's the holidays. People are still optimistic that they're going to get their present, which is low inflation, 2% inflation once again. and we can just leverage everything up and asset prices will go to the moon and there's no risk. So everyone's hopeful that we're going back to that. And for, those who are listening to the show know that that's not happening. So anyway, but we have been talking about how inflation is going to drop, and it has been. And I think it'll continue to drop. 6.1, I think, is a bigger than normal drop. We'll see how far that continues. I think it's probably not going to go below 5. But, at the end of the day, who knows? I'm not a fortune teller. So that's the first piece of news. And then the second piece of news is the Fed funds rate, which they raised 50 basis points to the range of 4.25 to 4.5. So that's slowed. We were going up 75 basis points. Now we're only going up 50 basis points. And the market was joyous and thinking, hey, we're going to have the Fed pivot soon and all is going to be right in the world. And then they came out and said, no, you're all wrong. And we are still going ahead to kill inflation. And we're not going to spike the punch bowl. We're going to end this party early if we have to, so you don't all get drunk and drive home drunk. So the Fed is clearly not giving everybody the news they wanted. And the market is showing that, because the market's been down the last 2 days quite handedly, in part because of what the news came out from the Fed meeting. So I think, the takeaways from this are, if you look at the market performance just as an indicator, you notice that, hey, people got a little excited there on Tuesday. And then on Wednesday, and then Thursday and Friday, the market has just said, all right, we were wrong. And now it's back down again. So I think for the most part, it'll be very unlikely we're going to get this so-called Santa Claus rally in the next 2 weeks, because there's not a lot to celebrate with the news out of the Fed. So Doug, what were your thoughts from all this? I know there's a lot going on out there about this.
Well, I think there's a couple things, and the biggest thing, I think, if I had to summarize it, is, Kirk, when the heck do you think people are going to start listening?
That's a good question. I would say never.
I mean, we've talked about this now in, probably going back for 6 weeks, that Jerome Powell came out a couple months ago. And he came out in Jackson Hole, and this is the last time we had a rally. And last time everybody thought, oh, inflation's going down. Guess what? The Fed's going to probably ease up on this. And he came out and he just eviscerated everybody. He said, I am not going to react to short-term news. I am going to keep focused forward on eradicating inflation. And he was ticked. I mean, he invoked Volcker's name multiple times because he was trying to let you know what he wanted to change over the pain that a lot of people went through the 70s and the 80s. He's doing his best to stay focused, not reverse. And guess what? Geez, surprise, surprise, surprise. Everybody starts to predict again that the Fed is going to ease up, that inflation's coming down, that everything's going to be great, and maybe they'll reverse their stance. He has not yet given any indication or clue whatsoever, Kirk, in any of these times that he's going to do anything such. But yet it tells you a lot about the level of arrogance that is out there of people that make these predictions, right? And I think there's some studies out there that show that some of the people that have the biggest PhDs and the biggest credentials tend to be the most wrong, because they are so enamored by their own intelligence that they will wait to the last minute, if ever, to change their view, right? And I think we're seeing that time and time again. Again, this expectation that the Fed is going to do something completely different than they have said they're going to do is an issue that just keeps repeating yourself. First time, shame on you. Second time, shame on me. Or what's the other one? The definition of insanity is doing the same thing over and over and expecting a different result. Hey, if I'm going to give any credit whatsoever right now to the Fed, okay, and there are people that have, there's a lot of things you can complain about it, and there's a lot of people that thought they waited way too long to attack inflation. But if I'm going to give credit to the Fed on this, I'm going to give credit in two areas. Number one, that when it took them too long to attack inflation, at least they were consistent in following what they said they were going to do, and they didn't waver on that, right? Well, they're doing it now. They're saying now we're going to attack inflation. And if anything, you could probably at least have some, some credence to think, hey, at least the Fed is being more transparent than maybe they ever been, because they're telling you exactly what they're going to do, and they keep doing it. And yet everybody thinks that they're going to just come out and do something completely different. And here we are again. Whoops, everybody's spooked. Why? The script has been read. Just listen.
Yeah, I think it's a lesson for all of us that what we're kind of accustomed to versus what reality is, right? It's like the boy who cried wolf. So, he kept crying wolf, everyone came running, and eventually they were just like, all right, we learned your trick and we're not coming again. And of course the wolf shows up and then, eats the boy or the sheep, or I don't remember the story, but the point was is, when the one big tool that the Fed has is their megaphone. It's the biggest tool they have. No one really talks about it, but everyone kind of just understands it. And so we get to this point where the Fed is the Fed has pretty much manipulated us for years, and now they're actually telling us the truth. And people are like, yeah, whatever, Jerome. We don't buy that. We don't buy what you're selling. We know that you're going to pivot soon, and then all is going to be well in the world. And of course, the market prices in 6 months ahead. So if you're looking at the market, it's a discounting mechanism, which they're looking 6 months from now and saying, well, they're going to pivot in 6 months, so now's a good time to start buying. And that's why the market started to go up, because people were figuring, oh, in 6 months, inflation will have peaked and interest rates will have peaked and we'll be heading down. And then they'll be pivoting. Well, there's no inclination that that pivot is going to be a pivot in the opposite direction. So the Fed funds rate is going up. Inflation is coming down. So at some point they're going to meet, assuming those trends continue, which of course there's no assurance of that, but assuming that happens, those trends will eventually meet, and then they'll find an equilibrium. Well, what does that mean? That doesn't mean that inflation or rates are going to drop. It just means they're going to find equilibrium. That equilibrium may be 5, 6%, 7%, wherever it is, doesn't matter. But that equilibrium is where the new rate of inflation and the new interest rates are. So a pivot, most people think of a pivot as, oh, we're going to go back down to zero and I can just go all in tech. Well, that's fine if you believe that's going to happen. I don't know anyone else who believes that, but I think a lot of retail investors believe it, or at least they're conditioned to believe it. And so they're kind of, it's like Pavlov's dog, right? They just see, oh, Fed pivot. All right, we're going to go all in. But the problem is a pivot. What is a pivot? No one's defined that. People have just thrown that out there and as a term, and now it's used. Oh, it's a pivot. They're going to change. Well, it could be just they just flatline, and the new rate ends up being 5.5 or 6%, and it just stays at 6. We'll call it 6. Let's say it stays at 6%, and that's just the way it's going to be. Okay, that's not a pivot in my mind. That's just, hey, we're taking a breather. Maybe it goes back up. Maybe it goes down. I don't know. But I do know that a pivot is very different from what I think is probably going to happen. So I think people need to kind of wake up to that fact. And I wanted to share a few things which I think are really timely. So if you look at, let me see if I can share this again with my tech savviness over here. Here we go. So, all right. So this is a chart which I don't know if you can see it, but I'll try to. There we go. So this is basically, and I want to bring this up because we've been talking about this for many, many weeks about how the market is not accurately pricing in reality. And this is another example of that. So this is the implied Fed funds target rate. So all those dots, that's the dot plot that everybody talks about, where all the different, people predict, where the potential Fed funds rate is going. So based on this, they're predicting somewhere between 5.25, somewhere in that neighborhood, 5.1, which isn't really what they'll do, but just say 5 and 5.25 in next year. Okay. Right now it's about, between 4.25 and 4.5, 4.4, I think is where it is. So that pink line is kind of the average for the dot plot, which is, kind of what is being stated. Now, the black line is the Fed funds futures. That is what the market is predicting. So the market is predicting that we do not go any higher than the rate we're at now on the Fed's funds rate. Think about that. Powell just came out and said, as Doug illustrated, we are not going to slow down. We're going to kick inflation's butt, and that's just the way it's going to be. And we're going to keep raising rates as much as we have to. And yet the market is saying, no, you're not. We don't believe you. It's not going any higher than it is now. Clearly there's a discrepancy between the guy who holds the scepter and everyone else in his court. The guy holding the scepter is saying, no, I'm going to do this, and everyone else saying, yeah, sure you are. I'm pretty sure I know who's going to be right, and it's not going to be the market in this case. And it's brought up a point I was thinking about this week. The term "don't fight the Fed." It's funny how people always say "don't fight the Fed" when interest rates are low and the Fed is easing and there's a lot of liquidity. But they never say that when it's going the other way. But the principle still holds true. Don't fight the Fed. If the Fed's telling you you're going to do something, don't say, nah, no, you're not, and do the opposite. That's a great way to lose money. But if the Fed's saying, yeah, we're going to keep raising rates, and you're going to be buying stocks like they're going out of style and thinking they're going to lower rates, then you're going to lose a lot of money. So I always found that funny of how "don't fight the Fed" only works one way, at least in social media. In reality, it works both ways. So I wanted to share that one, and I also wanted to share one more here, which is there's a implied path, and this is actually older, so I wanted to kind of show this one too. It's a little bit older. It's from last month, but I think it kind of illustrates the point, which is, the black line is basically what the Fed funds rate is, and then the blue lines are different points in time. So I have to describe this because people will get a little confused. So what happens at each point in time, there is an implied rate. So it's kind of like these are the predictive outcomes, right? So at each kind of stair step, people say, all right, here's what we predict is going to happen. And so all these lines, they're not really each kind of stair step, a bunch of lines come out from each one of those 90-degree angles. So if you look at it, you're like, all right, well, this is the prediction, right? And this is a good example of what it was last month. People were predicting it would go to 5%, and that would be it. So all of these the effective funds rate versus the applied rates are really important because it shows that reality doesn't necessarily line up with with the expectations. So it's just something to understand, because many times we have our expectations, then we have reality, and we don't really piece those two together. I think if you look at the political sphere, you can see that every single day. Reality doesn't match up with expectations, but I think it's an important concept to understand, because if you don't, you'll be confused a lot. So what are your thoughts on these, Doug?
Well, I think I'm glad to see that there seems to be some agreement that things are going to that we're going to have a cut on the Fed funds rate by 2025. Not only the Fed futures believes this, but also the policy, the FMOC members are all agreeing. As a matter of fact, by 2025, the expectations on the Fed funds futures is that the Fed funds rate will actually be higher than what the Fed is saying that they think it's going to be. So, I'm just, I think we just sit there until 2025 and everything's going to be all hunky dory, Kirk. I think, on a reality based standpoint, I think you said it best, right? It's the "don't fight the Fed" concept. They have so much control over what happens, so much control over the cost of things, so much control over market performance. Just the way our economy works and the way our monetary system works, what they do and what they say has tremendous impact and immediate impact. And so if you're, and I get it, it's like you just said, what have you done for me lately? We don't trust you. Going back to the boy who cried wolf, just kind of go back to that story, Kirk, you were kind of right. The wolf, again, the boy cried wolf and everybody came, there was no wolf. And then, he cried wolf again and everybody came and there was no wolf. And then finally, the wolf came and he cried wolf and nobody came because they got sick of hearing that there was a wolf. And Kirk, he did eat the sheep. The wolf ate the sheep. but then he ate the boy for dessert. So he got both of them. Okay. So, I mean, so
I was half right.
at the end of the story, he left the straw and for somebody else. But, here we are. I mean, we're talking about Fed funds futures that are being predicted by people on Wall Street, but we're looking at Fed's fund predictions based on FOMC members. Just out of curious, Kirk, which one of those actually are involved with the decisions about what the Fed funds rate is going to be? Is it Wall Street or is it the members that vote on it?
Voting members, of course.
The voting members. So if the voting members are thinking the Fed's fund rate is going to go up to over 5%, and as a matter of fact, there looks like a couple members that were looking at even over 5.5%. Would you be more inclined that the person that's actually voting is going to be more accurate than the people sitting in Wall Street praying that it goes a different direction? I'll go back to 2008. I mean, shoot, there's a major company, I won't name it, go watch the movie if you want to, that kept saying real estate's going to keep going to the moon. Well, by the way, I believe there was a department within that same company that was betting a huge short on real estate and being fought against the powers that be in that major investment bank because the investment bank, I don't know, Kirk, might have had some biased reason to hope that real estate continued to go up. So maybe there could be a little bit of play of the people that are putting their money on the line. I would tend to cite a little bit more accuracy from the people that will actually cast the vote. That's just me. And it seems to be, not a lot of outliers. Now, we get to 2025. I mean, you've got some people thinking that, the Fed's fund rate might be now down to, 2.4. We've also got someone that someone on the member board that's saying that they think the Fed funds rate will still be at 5.6 at that point. So yeah, 2025, we got a real spread of people with votes that have no clue. It's 2 years from now. Right? But if we're looking at 2023, all those blue dots tend to be pretty concentrated in the same area. I mean, you may want to argue over 4.75 versus 5.75, but I mean, at that point, Kirk, does it really matter? I mean, it's going to pinch either way. So you can go ahead, listen to your analyst who may or may not be holding a ton of stock tied to that interest rate. Or you can go ahead and start listening to the people who have repeated themselves, I think, 3 or 4 times and actually shown we're not crying wolf anymore. The wolf's at the door. And by the way, we said it, we did it. We said it, we did it again. We said it, we did it again. And guess what? At some point, you got to start thinking, well, geez, we lost our flock. Maybe the wolf is actually coming, and forget the whole, the crying wolf. I mean, you can go back to previous Fed chairs. And yes, maybe their philosophy on rhetoric. I mean, we can go back to Janet Yellen and be honest with you, not a political statement, but where she's gone since then, some of the decisions and things she's come out and said since then make you wonder about a lot of the decisions that were being made while she was Fed chair. Okay. And there was a lot of probably ineffectiveness going on there. But we have a Fed chair now that forget the past, forget the crying wolf. Jerome Powell has been incredibly transparent and incredibly consistent on following through with what he's told you to do. And at this point, if you are not getting in line, you are fighting the Fed. And if you're going to fight the Fed at this point, I think you're going to get bitten and you're going to feel it bad.
Yeah, I couldn't agree more. Yeah, I think we've certainly got some challenges ahead of us. And I think, look, just like everybody needs to listen to the Fed does listen to Wall Street. They don't necessarily take everything they say and do it, right? It's not like Wall Street says you're going to do this and they just do it. There are times in the market where that does happen, where the Wall Street puts a lot of pressure on the Fed for various reasons. It could be the system's breaking. It could be that they think they're wrong. All sorts of reasons. Like, the Fed keeps rates low and Wall Street's like, come on, you got to raise rates. Like you're killing the market here. So they do take influence from the market, but they don't take direction from it. right? There's really just the voting committee members that vote on it, and really it's mostly Powell, but the voting committee members are also have a lot of say. I do want to point one thing out, because as we were going through tech issues in the beginning, my brain was frazzled, and I think I said 6.1 and 6.7. It's actually 7.1 and 7.7, but that's what happens on Friday when your tech doesn't work and your brain's a little screwy. So for all you trolls out there who are just waiting to lambaste me, I corrected myself, so go home.
Hey, if you got trolls out there ready to lambaste you, I would call that a successful podcast, Kirk, because that means that there's enough people listening that you're making waves. So, hey, if there's trolls out there, bring it on.
There's trolls coming at us every week, Doug, and love us or hate us, just just
Love
listen to
us
us.
or hate us, just keep clicking.
Yeah. So yeah, we got plenty of that. So I do want to point out a few charts here, and then just some interesting things we've seen, and obviously want to get back to housing because that's a big one. So here's one that we've seen recently, which I thought was really fascinating. And for those of you who don't use Fred, which is basically, I think it's the St. Louis Fed, does this. It's a fantastic tool. You get a bunch of economic data. And they pull in a lot of various sources, so it's like a centralized place you can get this. And there's charting tools. It's phenomenal. I use this stuff all the time. So here's one, which is basically the blue line is consumer loans. So this is credit card debts, revolving debt, and then the red line is personal savings rate. Notice anything interesting, Doug? Well, for those of you who are just listening, I'll kind of illustrate it. So the consumer loans were going up until COVID, and then they dropped, obviously, quite a bit. And then right around first quarter of 2021, they started to pick up, and they've been going through the roof. They've just going straight up. So I would imagine that's probably when the COVID money ran out. And then if you look at the personal savings rate spiked during COVID, obviously, because people got a lot of money, and then spiked about 9 months later. And then it's just gone through the floor. It just keeps dropping. And right now it's around 3% for personal savings rate, which is horrendous. I don't know what it is globally, but I know historically when it gets to 3%, that's a bad sign. That means either most people don't have money, they're certainly not saving it because they don't have it. And it just means that people are taking a lot more debt. They're leveraging themselves up, which means that at some point people are going to hit that limit, and then they stop spending because they can't. Not because they can control themselves. It's not like people all of a sudden, they got religion and decided, hey, we're going to stop spending and we're going to pay down our debt. No, it's because they hit their limit and they can't buy anything else. So once that limit is reached, we're all seeing kind of like the end of that bubble, and you can't leverage it up anymore because there's no more availability, right? If you think about it, like credit card debt, I think it was 2 years ago, I was able to get one of my credit cards was like 5-6%, maybe it was 4. It was really low. And the other ones were right around like 9. It was just, standard, I think, in the industry, but this one was really low. This year, I think they're up 10% each, all of them. And my credit hasn't changed. If anything, I'm using it less, but my credit hasn't changed. But they've ratcheted up because they quote unquote have to make a profit. And I say that in air quotes because every time I call them and say, hey, you guys are really kind of screwing me over here with these rates. And they're like, oh, well, we need to make a profit too. I'm like, really? Did rates go up 10% in the last week? Because I'm pretty sure they didn't. But somehow you guys are able to squeeze it out. So maybe I'll just pay down my debt and not use you guys till you give me better rates. But I only say that because I know I'm not alone. And everyone's rates have gone up. And look, at the same time, you see this chart, consumer loans have gone through the roof. So you have rates going up and the amount of money borrowed is going up, which means a lot of people are going to be in trouble. And I think we've been talking about this for many months on the show. So all of you who have been listening for a while, this is just because we're early doesn't mean we're wrong. We were early on this trend. We saw it right away. And now you're starting to see more of the data actually kind of creep up and show that, hey, there's a real big problem here. I don't know where that end point is where people cry uncle, but I think we're starting to reach it. Most likely we'll probably see it mid next year because people still have money. Apparently they're still spending it. And they seem to not be aware that that they're raising rates. But hey, teach their own. I don't know everybody's balance sheet. I just know that we're going to see some trouble probably next year. So, what are your thoughts on this, Doug?
Well, actually, I was looking at some trends, and unfortunately, the Consumer Financial Protection Bureau tracks mortgages that are 30 to 89 days delinquent. And unfortunately, their data only goes till December 2021. But what I can tell you is that there was a tremendous drop in delinquencies. Interestingly enough, they actually started around January 2020, and at that point we were around 2.5%, 2.2% delinquent, and actually it had been steadily declining. I mean, go back to 2008, it was 4.2, so it had been steadily declining, and then it just dropped off. All of a sudden, you go from January 2020, 2.2% are 30 to 89 days delinquent to 0.08. Okay. And it continued to go from there down to about 0.6%. Now, I'm sorry, 0.8% to 0.6. Now, we can all probably assume a big reason for that, right? There was all that stimulus money. And people started to pay off a lot of debt. But what I can tell you, and again, I don't have any 2022 data, but would you agree, Kirk, things are a little harder now than they were in 2021? I mean,
Oh, much harder. Yeah,
absolutely.
absolutely.
So from the time that you from basically March 2021 till getting down to a 30 to 90 day delinquency to the end of 2021, the delinquency rate had gone from about 0.6 down to about 1%. So that was a 0.4% shift just over the last 6 months of 2021. There is some new data coming out, which I don't have the exact numbers on. And unfortunately, as I said, the Consumer Financial Protection Bureau does not have more recent data out there. But I saw an article recently that something like 30% of mortgages that were purchased in the last 2 years are now going delinquent. So we are absolutely seeing. We're going to start to see. I have a very bold prediction that I'll go on a limb on, that when we start to see the delinquency rates that are going to now be published at the end of 2022. We're going to start to see that mortgages are starting to get a little bit scary for those that are homeowners out there. So we keep thinking that this supply and demand. We've talked about real estate. We've talked about what's happening to to homes that are for sale and the prices. I saw some data today that in places like Austin, Texas, they've already seen 10 to 20% declines on home prices as some of the biggest cities out there. That's just for people that are trying to sell their home. That's just for people that are trying to buy a home. That doesn't talk about what is underneath the covers. The old saying from Warren Buffett, you don't know who's swimming naked till the tide rolls out. The tide's starting to roll out. And I think what you're going to find in some of this data is, and you're seeing it here on this Fred chart that you showed, just on personal credit cards. But that is only part of the problem, because people, you know this, Kirk. I mean, if I gave you $1 and you had to use that dollar, you had things to pay. What's the last thing you're going to pay? Probably credit card debt, right? And you're going to pay for food. You're going to pay for clothing. You're going to pay your mortgage because you don't want to lose your house, right? So if credit card debt is spiking like this, it may be part of the sign, okay? Because people are riding that out and they're going to max their credit. They're going to hit a limit. But when we start to see the mortgage data and we start to see that people are not paying that either, that becomes a crisis that starts to affect everything else. Because if all of a sudden, and I'm having some issues on focus on my camera for those of you watching, I'm sorry. But when we start to see the data on mortgages, okay, so we think there's a housing value issue now. People that are behind on their mortgages might want to start selling those houses to get out of debt, to get out from being behind. And now all of a sudden we talk about supply versus demand and what that can mean. So, all right.
Yeah. So I want to share a few quick things as we get into housing here, which I think is important. So first one, this chart, this is the personal savings rate we talked about before as a percentage of disposable income. This is 2.3. I think this is a more recent one, but it hadn't been back this level since 2005. Remember what happened in 2005, Doug?
Oh, I believe that there was something happened with the real estate, didn't it? With
Yep.
housing?
That is when real estate prices peaked. They peaked in 2005, and they didn't crash until 2008, and then they didn't bottom until about 2010 or 11. So you basically had 5 years where real estate prices dropped, but it wasn't until year three that you actually started to feel it. So in this chart, just shows this is when we got to these levels. So if you want to talk about excess, this is excess. This is where we are now. And it's not excess necessarily because people are being crazy, like they have in the past, like in the late '90s, and certainly prior to the real estate bubble, people are getting crazy. I mean, people are a little crazy, but I think a lot of it is just people are having a tougher time. There's a huge amount of layoffs, which I'm going to show you right now here. There's let's see, let me pull it up here. We just had, here it is. So I mean, this is just tech companies. I just found this chart fascinating. What actually I found funniest, because I think well, one of the big financial, Goldman Sachs just said they were going to lay off like 5 or 6,000 people today. One thing I found comical, and I just wanted to point this out, is everyone was lambasting Musk for laying off a bunch of Twitter employees, but no one said anything about Meta or Amazon or any of these other companies, and they laid people off. Apparently, it's only Twitter that's a problem. But I think what this shows, just to get back to the point, is there's a lot of layoffs. I mean, this is November. 50, almost 60,000 people laid off in November in tech. A lot of tech layoffs this year, and in large part that's because they have to. Right? You have bloated amount of employees, and it's great if things are going up because you can. But if you have to actually make money, because there was the Twitter files came out recently, and they talked about how basically people just had a cushy job. They didn't have to work very hard. They just showed up, and no one was really pushing them. There were no annual value evaluations. People were just kind of floating around, just doing their thing. And not saying all companies are like that, but I think with tech it's a little different because people are trying to own the space, so they're not about making money. Once you get to a certain size, like the size of Amazon or Meta or Microsoft or Apple or any of the big ones, yeah, you have to start making money. But if you're in the explosive growth phase, you don't necessarily have to make money because people discount that. They say, well, what's more important is you get exposure. So I just want to kind of throw that in there because I thought it was interesting. But I did want to kind of touch on a few things on housing. Now, if you look at, see if I can bring this up. So getting back to wages, this is median earnings with salaried employees. So you can see that's kind of dropped a lot, and I assume that a lot of that has to do with the layoffs. But it's not a good sign when you're looking at this over like a 40-year period and it's just dropping like a stone. So just something to think about. But I wanted to look at, let's see if I can find it. Here we go. Fastest housing slowdown on record. Now, you all know that I've been ripping on a lot of these people who put out these fastest Fed rate hikes in recent history, and none of them show the 70s or the 80s. They just show you the last 10 or 20 years, and they're like, oh, it's the fastest in recent history.
Well, you're just Kirk, I think we've had the fastest decline in crypto in history.
I think technically it is at this point. It's in history. In the last every 3 years you get this, but I think actually right now it is history.
We've got that whopping window of a couple of years of data. So continue.
Yeah. So, but looking at this fastest slowdown in history. So I'm not saying like, wow, this is something you need to jump out a window because it's the fastest slowdown. I'm saying this to illustrate a point. Now, has it been faster in the past? Probably. I don't know, but I don't really care. What I'm using this to show is that there's a big deviation from even some of the times in the 70s. Now, I will point out that the 77, 83 were not really times of big sell-offs in housing, because rates had gone up. Because we had a low and then rates have been going up for a while. So I don't want to misconstrue this. I didn't create this. So I don't want to misconstrue what we're trying to point out here. What we're trying to point out is the fact that there's a big deviation over the last 40 years, and you should just see how large it is. That's 7 months and 24% is large. I don't really care what else it is. It has done in history, but at least you can see history and say, all right, there's a big difference here, and you should be mindful of what that difference is.
Yeah, and Kirk, I think looking at this chart, I mean, we're not talking, we're not talking about largest decline in home sale pricing and value. What we're talking about is the cumulative change of existing home family sales in Fed hiking cycles, and there is some correlation. I mean, there have been talk about how fast the Fed has layered in these rate increases. Right, they are just slamming every quarter, boom, 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 boom. So I think that if you look at the economic situation of, say, something like the 70s, where it was just this more, I think you would agree that it was more of this gradual strangulation, right? I mean, we had the oil embargo, we had the high inflation, just the dregs of coming off the Vietnam War. It really was one of those things that because it just kind of settled in like a thick fog, it didn't necessarily have that shock value that we are getting right now. And so when you look at all of a sudden this massive, 20 some percent change in a short period of time in home sales. Now, granted, some of that's correlated to the time of year, right? It's fall going into winter. We always see a slowdown, but that would be represented in all of these different graphs. But I think what's happened is, and it comes back to addiction, right? We have been in a monetary and interest rate and easy money addiction for so long. And that addiction is, even though that, again, historically, 6-7% is nothing in terms of cost to borrow. A 5% Fed funds rate is nothing historically. But because of what we're used to, because people have been under this impression and this myth that you could just continue to get money so cheap. If you go from 2.5% to 7%, and I'm seeing car loans now being, for 700 plus credit rating, they're getting car loans from banks like Chase for 8.5%. Okay. So when you see that spike that quickly of that kind of change and you're that addicted to it, it's kind of like getting off heroin. We have the reaction to it, and we like to talk about heroin
Not
on
that
this
we've
show,
ever done
Kurt.
that.
Not that we've ever done that, Kurt,
Never,
but it's
never.
kind of like that reaction. Too much getting off of it too quickly can kill you. And in the short period of time of the drastic measures of trying to make up for this spike in inflation that we've got from all of this monetary supply and supply chain issues and all the other things that happen with that whiplash, that bullwhip effect, we have a society that is, as we've seen from the Fed, they're not buying what they have to say. They're kind of living in a dreamland. They're not heeding the warning signs. But what they've seen really quickly has put everybody into some sort of an epileptic shock.
Yeah, no, I totally agree, and I think that's an important point that's probably lost on a lot of people is the fact that you know when you're accustomed to something, you make assumptions, right? And what I think is challenging for a lot of people, and this is why we've been beating the dead horse over the last 6 months, is when people are accustomed to a certain thing, it's really hard to change your mind. And so people have been accustomed to low rates and low inflation. They've been accustomed to buy and hold. They've been accustomed to tech stocks always outperform. They've been accustomed to, there's really no risk in the market. You buy the dip. People have been accustomed to all these things. And when you're accustomed to it, you stop thinking, right? Real estate always goes up. Remember how that worked in 2008? And that's why the system broke, because real estate always goes up. That was the assumption. That's what people were accustomed to. That's not true. And we found that out to be not true after the fact. But, when you have the Federal Reserve basically manipulating the markets, and it's not just them, but they're one of the biggest contributors. They manipulate the markets for a certain outcome. They're doing it to make people feel better. And is there positive outcome to that? Sure. But there's also negative outcome, right? If you think about, if you think about like a beach ball, right? You hold a beach ball underwater, that's fine. You can hold it underwater all you want. But the deeper you go, at some point, that beach ball is going to shoot up and it's going to shoot way out of the water the other direction, right? You can't it's not going to just go up and just settle on the surface. It's going to, there's what we call kind of reversion of the mean. But what happens is it kind of goes in excess in the other direction and then eventually settles in the middle. And I think that's what you're going to see. But what that means is, because things have been so expensive, it means they have to go in the other direction. Because if they don't, then we're just kind of perpetuating this charade. And I think that's part of the problem. So I wanted to talk about this chart here really quick because I think it's important. We talk about renting versus buying a lot in the show, and I think it confuses a lot of people. I know a lot of people feel like they need to own a home because if they don't own a home, like they're not successful or they're not making money or 10 million other things that they think. But what this chart is meant to show is basically the last 20 some odd years in different time periods to show that there are points in time where it makes sense to own and there are times where it makes sense to rent. So if you look at pretty much the first 10 years of the millennia, it was more expensive to rent, so it was better to own, which I think we all knew because you could basically borrow money at 0%, not pay it back for 10 years, and you could own, and there was no risk, and the markets always went up and all that. So it was really cheap to buy, which is why people were buying. So it was a lot more expensive to rent because no one was renting stuff out when you could buy it. Now it's more expensive to own, much more expensive. You could see that spike where things have gone through the roof. Well, things were maybe a little bit more reasonable. And then after COVID, everyone went to buy a house. They moved out of the city. They rethought their plans in life. And now it's doubled the cost that it cost before to own a home. So if I were to buy a home today, it is going to cost me twice in monthly payments than it cost me 12 months ago. That's crazy. It's crazy to think that that's even possible. But and yet at the same time, the house prices have not gone down. They're pretty much the same. So basically, my payments have doubled. And if I'm buying a house that fits within certain ratios that are allowed by the mortgage companies, you can't really exceed those ratios. They won't lend to you, which means I can't afford the same amount of house that I could have afforded before, which means I have to buy half the house. Well, if everyone's doing that, it just means that no one's buying the higher end houses. And at some point, the house prices go down. So it's not going to happen instantly, but it's going to happen. And you should just be aware of it. So
Well,
that's
Kurt,
why we wanted to show this chart.
and Kurt, going back to that last chart, I think that's exactly why you're seeing that massive decline in home sales right now, because what you have is you obviously have you have two parties living in disbelief right now. You have the buyers who are in disbelief on what it's costing to be able to get somebody else's money, the bank's money to buy, and also just even getting approved in the first place. And then you've got the sellers. The homeowners are in disbelief as well because they expect to be able to sell their house for a certain amount of money. They become accustomed to watching their neighbors sell their houses at more and more and more. I saw it in my own neighborhood earlier this year. I've talked about it. A home goes for, two similar homes right next to it. One goes for over about 1.2. And just a couple months difference, all of a sudden, this other house goes on the market very similarly, and they went for they put it on the market for just over $1 million. Guess what? Didn't sell. They went down to 950, didn't sell. 900, didn't sell. 850, desperate, paid off, guy trying to didn't sell. And guess what? Pulled it from the market. The sellers are having a very, very difficult time now facing the reality of what this new economy is creating for the value of being able to transact on a home. It's arbitrage. But again, going back to what you said, real estate always goes up, right? People expect real estate always to go up. My neighbor got this, so am I. It's supply and demand. There's not enough homes. There's not enough places to sleep, Kirk. And that's the chart you just showed exemplifies that. When homes are too expensive, people still need a place to sleep. So they're going to go rent. That drives up the price of rent. When rents get too expensive and people move there, then the price of housing is going to come down into equilibrium. It goes back and forth and back and forth. The key is people will always need a place to sleep, but there has to be an affordability. And at some point, if the rents are too expensive, because people are going to say, well, that'll just spike the rents. Well, if you can't afford the house, you can't afford the rent. Now you get homelessness. And that's an even bigger problem, right? And that's where we might be headed. We honestly might be headed to a massive spike in homelessness because people, I hear it all the time. People got into real estate because the cash flow they can make. I was listening to someone today talking about another double-digit increase they were going to do to their renters. Okay. You can't keep doing it. Layoffs are happening. Incomes are flattening out. If we go into a recession, renters won't be able to pay their rents no different than homeowners can pay their mortgage. And ultimately, at that point, you're only going to be able to charge so much before, in the end, people just won't have homes. Won't have housing.
Yeah. Yeah, I think it's a big challenge. Obviously, we'll see what happens, but I think what if history tells us anything, it tells us that when things slow down, everything slows down. And I do think housing prices are going to come down because they're going to have to, not because people want them to, but because that it just everything, the economy kind of all works together, and sometimes politicians and the Fed, they try to move one sector or one part of the economy, and it causes unintended consequences over here. So I think what you're going to find is, yes, they're raising rates because they have to, not because they want to. And that's going to move a lot of levers in other parts of the economy in a negative way. So the Fed has said they want to destroy demand, and they didn't say send us into recession, but destroying demand basically says you're going to recession. And I don't think they haven't really, I guess they denied it once, but they haven't said the word recession because I think it's politically unpalatable, but that's what they're basically doing. So I wanted to show this chart, and I wanted to kind of wrap it up in the interest of time. But this is a chart I saw the other day, which I thought was fascinating, which is the year-over-year home price appreciation. So just to show the severity of what's happened in the last 2 years is, normally we're getting about a 5%, which I think is generally pretty normal. And then COVID hit, and then it spiked up to like 16.7%. 18%, I think, at one point. But what's important just to take away from this is just, let's look at the trends, right? We talked about reversion to the mean. All right, well, reversion to the mean, this went from 5% up to close to 18%. Well, that means it probably has to go down at some level to find that equilibrium, right? If you think about, let's say hypothetically, let's put a line through 5% and say historically, this is what it has been over the last 100 years. I don't know if that's true, but hypothetically, let's just say it is, right? So you go up to 18% one year. Well, that means that some other year you're probably going to have to go to like negative 23% or something to be equivalent. So just something to take away from that is that, there is a balance and an order to the world. And when things go out of balance, they go the other way. Think of the tech bubble, right? Everyone made a ton of money. People were making 100% returns a year on stupid stocks that weren't earning any money. And then the subsequent years, the market was down, over 50%. So things balance at some level, right? It's just, you just hope that you're not the one holding the bag on that. You hope that you're smart enough to get out before things get bad. It's kind of like with the crypto boom, right? People made a lot of money in crypto, and those who held on have lost a lot of money in crypto. Now, I look at crypto as this is normal, right? Every few years, the crypto market drops 70%. That is normal. And if you're prepared for that, it means you can go buy crypto 70% discount. And I think given what's going on, I just saw some news clip against Binance, and after FTX kind of imploded, now they're going after others. And I think they interviewed what's the guy? I forget the guy's name. A Chinese guy who runs it, Binance. You know what his name is? Drawing a blank.
I'm pulling it up. Give me a second. Yeah, no, give me a second.
Anyway, well, I'll get back to that. But CZ, I think, is how he's referred to. But
Changpeng Chow.
Yeah. So CZ is how people kind of refer to him. So if you look at him, like I saw him interviewed, and he was on CNBC, and they asked him a question. So what would you be able to come up with $2.1 billion if you had to? And his response was, yeah, we'll be fine. We'll have enough liquidity. And I saw the anchor. She just rolled her eyes visibly in the screen. I couldn't stop laughing. She was like, oh, wow. And then the comment on Twitter was like, all right, everyone pull your money. I was like, that's not good. So until this kind of challenge in the crypto space kind of subsides, because right now people are just running around with their hair on fire, and they don't know what day it is, and they don't know where all the challenges are. And I can't blame them. I mean, if you don't own your crypto in the right way, everything's suspect. If you're holding your money in exchanges, people will tell you flat out, don't hold your money in exchanges. Use it for trading, not for holding. But people still hold it there because they're lazy. So if they lose money on that, then that's up to them, right? I mean, if an exchange is having problems, like MF Global is an example, they did futures trading. I had an account at FM Global years ago. It was just for futures, just because I just wanted to play around and have fun with it. And anyway, I was just sitting in cash. I didn't have anything. And I was at a conference, and I was watching the news, and it's like, oh, MF Global, and the stock was like plummeting. It said having financial problems. I'm like, all right, time for me to pull my money. wired it out same day. Next day, they froze all assets. So I got really lucky. I got out in time. But the point is, when you see these things happening, you have to put on your risk management hat and say, hey, what can I do to protect my assets? Because you don't know what's going to happen. These complex systems, things break, like 2008. It broke for many reasons, but one of the reasons was the system was too complex that nobody understood it. They didn't understand the risks that were being taken at a firm level, at an individual level, and they didn't understand the risk of the security. Right? You look at The Big Short you referenced earlier, Doug, and how people like Mike Burry basically were shorting the housing market, and everyone's laughing at him like, "I'll take your money, you rube." And he made he turned them all into laughing stocks because he basically just walked away with all their money because he was smart and they didn't know what they were doing. So I think we're seeing that now, and there's definitely some smart players out there who are taking advantage of this. But there's a lot of people who are just walking around saying, "I don't know what's going on," and they end up losing money. So I know we're going to wrap it up here, but final thoughts from you, Doug.
Well, yeah, I want to go look at that chart you're talking about. And again, this goes back to some of these charts, right? The national HPA for April averaged 13.6% based on, I'm looking at an April chart. But if we take a look at the average, you can see here that year-to-year rate of HPA, home price appreciation, it's 6 up to 8, down to 4, up to 8. You look at that average, it's kind of the 6%. And I can see why people have said real estate is absolutely the place to invest. But again, this chart goes back to 2013. We've been in low interest rates for a long time, Kirk. Do you think that 2013 is including the history of true interest rates and lending pricing?
Nope.
Oh no. If we go back to the national appreciation rate of 25-year average, it's only 3.9. Okay. So, and if we go, and I forget the name of the Nobel Prize winner that did the calculations back to the end of the Civil War before the recent appreciation, kind of the same thing, about 3%. So housing in general has appreciated just at the rate of inflation. But if we go back and I think just got a summary of a lot of the charts we've talked today, is that one of the things that I think we're facing that we have, and maybe I'm wrong on this, but I would believe to be very probable, is that we are facing a time unprecedented in the history where entire generations have grown up in a single style of low interest rate economic environment and have absolutely no concept of ever living through a time in which the economic data that they are living in was different. Okay, so you get a lot of half truths from this. You get a lot of things where people say you should always buy real estate, and there's people that have always said that owning real estate long term, there's a correlation, not necessarily causation, which you've talked about, Kirk, right, between owning real estate and financial health. Okay, but they've taken that to the next level of believing it as a full truth. Is look at how much real estate appreciates compared to everything else as an asset class, and that's just not true. The data is not there. So I think, once again, this just represents a lot of what people have lived through, and they have never experienced anything other than what is that pendulum swing, that reversion, that shift outside of the mean. And there's going to be some real rude awakening for a lot of people. And we're just at the beginning of showing them what life could become under this new paradigm shift. So just be prepared. And again, don't fight the Fed. I think in the summary of the whole thing, I think it's time we start listening.
Couldn't agree more. Doug, where can people find more about you as we wrap it up here?
I appreciate it, Kirk. I'm a business owner, partner with Craig Coles in a firm called Automatic Business Method. Look that up, automaticbusinessmethod.com. We actually have a systematic bulletproof process to skyrocket revenue for businesses, get ideal customers, create more free time, have the perfect team without spending too much time, having that work-life balance, not spending a high cost of marketing complex technology. Listen, the inefficiencies in business may work when economy is easy and times are great, but you may be working too hard. You may have more stress than you need. Your business name may not be as valuable as it could be. But if we start going into this shift to this economy and it gets harder to make a dollar, it gets harder to market your business, it gets harder to produce revenue as your costs go up, your cost of borrowing, those inefficiencies are going to boil to the surface. So now is a great time to find out the health of your business, to start looking at the streamlining and making sure that your business is going to be able to not only survive in this next economy, but really maximize what it could be for you, the life you want to live, the life for your customers and your employees, et cetera. So look us up, automaticbusinessmethod.com.
Great. Well, Doug, once again, really appreciate you coming on the show here. And we'll be doing this live again next Friday before Christmas. And then we'll be taking a little time. So for those of you who are looking forward to the live episodes, just know we're taking a little time for ourselves. But, we're getting close to the end of the year. So for all of you, thanks again for joining us. My name is Kirk Chisholm, host of the Money Tree Investing Podcast, also wealth manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app if you're choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to our show notes, resources, and archive shows. Also, we're now on YouTube, so please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment in the podcast app of your choice. Oh, and don't forget, do your own research. This show's for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling you any products or services and do not consider this advice. If you have any problems with the show, I blame Putin. So please call him directly and express your feelings, assuming he's still alive. If you're seeking financial advice, please talk to an oracle, fortune teller, or maybe a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.